Big tech is spending more than $500 billion on AI infrastructure this year. Goldman Sachs puts that number at $560 billion. That's bigger than the entire global venture capital industry in a normal year. And most people watching from the outside are calling it a bubble. People are comparing AI to the dot-com boom era. Now let's start with the obvious question. How do you justify these insane valuations? In May 2026, Anthropic entered talks to raise up to $50 billion at a $900 billion valuation. $900 billion. 2 months earlier, Anthropic raised $30 billion at a $380 billion valuation. In roughly 90 days, that company doubled its valuation. How do you reconcile these numbers? It's one reason. VCs do not price companies on what they are worth today. They price them on what they could be worth 7 to 10 years if everything goes right. After assessing 7,000 companies in my career and investing in 70 plus startups, I can tell you this is exactly how the math works. It's an upside game. And in AI, what's possible if everything goes right is bigger than everything we've ever seen. Here's the math. The entire global software as a service industry today is worth roughly $400 billion in annual revenue. That's Salesforce, Microsoft 365, Adobe, Workday, every SaaS company combined. But AI isn't software. AI is software that can do the work that humans currently do. And the global knowledge work, we're talking about consulting, legal, customer support, business process outsourcing, is over $10 trillion in annual revenue. $10 trillion. So if AI captures even 5 to 10% of that spending, you're looking at a market 5 to 20 times larger than all of software combined. That's the bet underneath these valuations. These do not even account for second-order market effects, essentially the unknown unknowns. We don't know how the markets will evolve that actually make the markets bigger than what we expected. And these aren't theoretical numbers. OpenAI hit $24 billion in annualized revenue this year. That's $2 billion a month by their own disclosure. ChatGPT launched roughly 3.5 years ago. From 0 to 3.5 years, $24 billion, that is unprecedented. Anthropic is even more extraordinary. Their latest reporting puts their annualized revenue between 40 and 45 billion. And this was at the end of 2025. That's more than 4 times the growth in 4 months in the billions. No software company in the history of software companies has ever compounded at this scale and speed. Even if you apply standard revenue multiple, SaaS companies typically trade at 10 to 15 times revenue when they're growing fast. OpenAI is $852 billion valuation. That is a revenue multiple of roughly 35x. Anthropic, 22x multiples. Those multiples are high, but they're not unprecedented for hypergrowth software companies. And here's the real caveat, something to have top of mind when you see these massive numbers. The revenue is real, but the losses are also real. OpenAI is projected to lose roughly $25 to $30 billion this year. No profitability expected until after 2030. Anthropic is also burning aggressively to fund compute. So these valuations aren't pricing on profit. They're pricing the bet that revenue compounds faster than the burn and that the market is much more than we realize. And this bet may be right. It also may be wrong. But it's an informed bet, not necessarily bubble thinking. Now, to the dot-com comparison, most people get it wrong. In the 90s, early 2000s, during the Web 2 internet era, when it's really started, people actually said the internet was overhyped. The market crashed, the companies that they thought would succeed failed, and the standard takeaway was, see, the bubble is real. But here's what almost everyone with this mentality misses. Software outcomes from that era were dramatically underestimated. Amazon hits roughly 100 billion at its peak of the dot-com bubble. Today, do you know what it's worth? $2.9 trillion. That's 30x the dot-com peak from the company everyone said was overvalued at the time. Google didn't even exist publicly till 1999. Today, Alphabet is worth $4.2 trillion, not billion, trillion. Facebook didn't exist. Meta is now worth $1.7 trillion. Add those 3 companies up, roughly $8.8 trillion in value, built almost entirely after the dot-com crash. The dot-com critics weren't wrong about the bubble. They were wrong about how big the survivors would get. And that pattern has a name. It is called Amara's Law. Roy Amara was a futurist who ran the Institute of Future in Palo Alto. He said, "We overestimate the effect of technology in the short term, and we underestimate the effect in the long term." That is the dot-com story in one sentence. The 2-year payoff was wildly overestimated. Everyone thought it was the next best thing since sliced bread. But the 10-year payoff was widely underestimated. And I think that's the AI story unfolding right now in front of our very eyes. Most billion-dollar AI rounds will not work, but the ones that do will make today's valuation look like child's play. That's not necessarily a bubble. That's a power law market function. A small percentage of the investments is going to account for majority of the outcomes. And that's what Amara's law was saying, and that is what it's playing out in real time. Okay, the uncomfortable part. If you take one thing from this video, let it be this. Look at who is writing the checks. Microsoft, Nvidia, Amazon, Google. These aren't independent venture investments. They are strategic positions that double as commercial relationships. And the money is going in circles. Let me show you. In late February, Nvidia invested $30 billion into OpenAI. And here's the part most coverage does not really focus on. Much of that $30 billion isn't really in pure cash. It's structured as GPU capacity. Nvidia ships the chips, takes equity in OpenAI, and converts this amount that they have invested into stock. So Nvidia isn't just investing in its business customer. Nvidia is in effect buying its own future revenue while taking equity in the customer at the same time. The money never really leaves the company, but the cleanest example is Amazon and Anthropic. So in April of 2026, Amazon committed up to $25 billion into Anthropic. As part of that same deal, Anthropic committed to spending over $100 billion in Amazon Web Services over the next decade. Amazon's investments recycle back as AWS revenue 4 times over. A week later, Google did almost exactly the same thing, up to $40 billion into Anthropic, $10 billion now, $30 billion contingent on certain milestones, with the explicit understanding that Anthropic runs heavily on Google's TPU chips. In 1 month, Anthropic received commitments of up to $65 billion from 2 cloud providers, both of whom have agreements for Anthropic to spend that money back on compute. So do you see how crazy this is? The scale of this circular referencing and circularity is unprecedented. The same dollars in some cases count as revenue on one hand, valuation on the other, capex on the third. These aren't pure equity investments. They are hybrid, complex commercial investment structures dressed up as pure equity in the press releases. And once you see the pattern, you can't unsee it. So what does this mean if you are a founder building an AI? 4 things. 1, the TAM, the total addressable market, is bigger than software. If you're thinking small, you're thinking wrong. And if you're thinking big, you need to think bigger. Because AI isn't competing with SaaS, it's competing with the global work knowledge economy. 2, read who is investing, not just how much. A strategic investment always carries strings. There's a commercial agreement underneath. Look at the use of funds, look at the compute commitments, look at the partnership terms. Strategic capital is almost never just capital. 3, watch the burn rates. The revenue is real. Profitability is years away. Ask what assumptions is being priced. If a company is valued at 30x revenue and there's no path to profit until 2030, you are underwriting a specific bet about the next 5 years of compounding. You're assuming that the market is going to be so big, they will grow so large that they will inevitably become profitable. 4, build for the 10-year payoff, not 2 years. Amara's laws tells you this. Most of what gets hyped this year will be disappointing by end of next year. The companies that survive that disappointment, the ones that keep building when the headlines move on, are the ones that capture the long-term value. Most billion-dollar AI rounds will not work, but it's the same with software. Some companies will return the outcomes we can't even imagine today, and the people writing these checks are sometimes the same people selling the picks and shovels. That's the game. Now you can read the headlines properly, and next time someone asks you, is AI a bubble? You have a more nuanced answer. One question I want to leave you with today is this circular money a smart capital strategy? Or is it a structural issue? If AI growth doesn't go as expected, what happens to these underlying companies that they're betting on? And I would love your thoughts. Drop your answer in the comments. I'll read everyone. And if you're a founder building an AI right now, 2 founders every month get a call with me as an early stage investor. The link is in the show notes. See you next time.
Tell us what you think of this episode on all of our platforms at the Startup Leap Pod. Do you have a question? Ask us and we'll ask our guests. Go to thestartupleap.io. See you next time.